Good morning. Thanks for joining us for our webinar this morning on what the USDA's prospective plantings and grain stocks reports mean for the 2015 crop outlook. We're looking forward to discussing that with you today and talking about some strategies you might think about using with respect to marketing crops for this year. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and joining me today on the webinar are my colleagues, Corrine Alexander, Professor in Agricultural Economics, and Chris Hurt, also Professor in Agricultural Economics. And let's talk a little bit about the outlook. And actually, the first report that came out was at the end of last week, and that was the grain stocks report. Corrine, let's talk a little bit about the results on that. And I guess, actually, I forgot. Before we do that, if you do have some questions during the course of the webinar, just email those to me at my address here at Purdue, jmintert@purdue.edu. And I will be monitoring those emails during the course of the webinar, and we'll address your questions during the webinar if we have the opportunity. If we don't, we'll address them by way of email back to you during the course of the day. So, but with that, Corrine, let's talk a little bit about that grain stocks report on Friday.
Right. So the grain stocks report was released yesterday at noon as well. So both of these reports were released yesterday at noon, which is a little bit fun because this is just-in-time delivery and analysis of what these reports have said and what they mean for the market. So what that grain stocks report gives us is some sense of how corn and beans and wheat, all these different commodities are being used this year and where we are in terms of progress. So what you see on this slide is what the stocks report is, and it's the stocks report as of the assessment of the stocks on March 1st. And then the second column there is what the expectations were relative to a Dow Jones survey of where the trade was expecting those grain stocks to be. And the last column tells you the difference. So if we take a look at where corn stocks are, we see that's about 7.7 billion bushels of stocks, about 117 million bushels higher than what the trade was expecting. So whenever we see that stocks number being higher than what people are expecting, that tells us that either production last year was higher or else usage this year has been lower than expected. When we take a look at the different usage categories, one point that stands out is right now corn exports are running slower than what's needed to meet those USDA expectations for usage. And so maybe lower corn exports is what's resulting in these higher stocks. At the end of the day, when you end up with more stocks than what you expect, that's bearish news. And you would see that, and we have already seen that in the lower corn prices since yesterday. Corn prices down maybe about 15 cents overall given where they are today. On soybeans and wheat, the report was much more neutral. You can see that the stocks that have come out are basically relative to the expectations, what the trade was expecting. On soybeans, this is actually a little bit, it's neutral, but it's also a little bit supportive because what it's saying is exports are remaining strong. USDA export projections are pretty close to where those exports are running. A couple other points, if we compare these stocks to where we were a year ago, one of the big themes that we're going to be talking about is how inventories in the U.S. have built up relative to last year. So those corn stocks relative to a year ago are up 11%. On soybeans, it's up 34% compared to last year. So we've really had a huge rebuilding in inventories for soybeans, and for wheat, it's up 6%. So across the board, all of those inventories are substantially higher than where they were a year ago.
So Corrine, you mentioned the fact that corn prices went down yesterday following the release of the reports, and the stocks on corn was one factor, but the other one was on the planting side. And let's take a look at the planted acres or intended acres for planting in 2015.
So the second report, exactly, that was released was what farmers intend to plant. And this is a survey that the USDA does of farmers in early March that's reported on March 31st. And the USDA asked farmers, what do you intend to plant this year? And so those planting intentions on corn have come out to an assessment of 89.2 million acres for corn acres that farmers intend to plant, down about 2% relative to where we were last year. On soybeans, farmers are saying they're going to plant about 84.6 million acres, up about 1% relative to where we were last year, and then wheat plantings down about 3%.
So that was a little bit of a surprise, right? I mean, the trade was expecting a larger reduction in corn acreage than what the survey showed, and maybe a bigger increase in soybean acreage than what the survey showed.
Well, that's right. I went into the report expecting 4% more soybeans, and we had 1% more soybeans. So that really was a positive factor, obviously, for new crop soybeans. On corn, I thought we'd be down 3% on acreage. We were down 2%. As we look at acreage going back the last several years, you know, we still have a lot of producers talking about, well, this is the corn era. The corn is king. We're planting more corn because of that big growth in ethanol. And of course, what we see here is that changed, and that changed actually several years ago. 2012, we peaked in terms of corn acreage. And if we think about the ethanol massive surge in demand, that really came from 2006 to 2010. Since 2010, we've been pretty flat, around 5 billion bushels of usage of corn for ethanol. Now, we had some poor years, 10, 11, 12, short production years, and so actually we're still trying to catch up with meeting the supply needs. But since 2012, we have been pretty much a plateau in the demand for corn for ethanol, and what's been growing is the demand for soybeans by China has continued to grow. So I think we're seeing that as we look at these line graphs of corn and soybean acreage. We've seen now 3 years of declining corn acreage and soybeans continuing to go up. Again, this is fundamental. It is the continued growth in demand from China on soybeans, but corn we certainly have flattened out more. So we're kind of seeing this re-emphasis back on where the growth in the world market is.
And you look at those acreage changes over that time frame, the last 3 to 4 years, it's been quite significant. We've lost roughly 8 million acres of corn the last 4 years, and we've put most of that back into soybeans, not quite all of it, but substantial change. Soybean acreage, I think, went from about 77 million acres in 12 and 13 up to 84.6. So,
yeah, we gained 7 million on soybeans and lost 8 million on corn, and so that is almost a one-to-one swap.
Yeah, so big change in the economy relative to where we were just a few years ago. And if we were talking earlier, Chris, about the possibility of seeing those two lines cross at some point in the future, is there a possibility we could see soybean acreage exceed corn acreage here in the next several years?
Well, I think that's the direction we would go at this point. And again, we're looking at ethanol probably relatively plateauing, maybe a slight bit of increase in usage there. We do have the whole livestock industry that we think will be probably multiple year expansion. So that feed base for corn is going to continue to increase. But really, we still anticipate some slowing in the rate of increase in China's demand for soybeans, but we think that's going to continue to be a factor. Now again, we have to look at South America, and they're going to get most of the new business that China has in terms of the expansion, simply because they can add more acres. In the United States, we're largely locked out of that. Soybeans have to beat out another acre generally. And so most of that growth will come in South America, but this could be what we will see. We'll actually see maybe in the next 5 years sometime, we could see soybean acreage passing corn acreage.
Yeah, so this trend is likely to continue. Maybe not at the same rate we've seen the last several years, but we're likely to see that trend
And again,
continue.
Yields around the world can have a huge influence on this, as we've got major competitors now, both on the corn, soybeans, and obviously on the wheat side.
Okay. Let's take a look at where the acreage changes occurred in terms of crops, Corrine, and you're looking at those planted acres. Obviously, corn down 2%, soybeans up about 1%. Let's look at some of those other crops across the board.
Well, this is one of those areas where I think, to me, I mean, and you've already made this point both pretty clearly, we're in a world where farmers are very much responding to prices and those different market forces. And so we're seeing for a lot of these other crops some pretty major acreage changes. And one of those highlighted ones is that fourth largest crop in terms of acreage base in the U.S. is cotton. Cotton, we're looking at a 13% decline in acreage. That's about 1.5 million acres. So we see a long-term trend there with cotton where global cotton prices are low. It just simply doesn't compete on profitability with the other crops. And so U.S. farmers are responding to that.
And we won't go too far into that, but I think that's China impact mostly and their lower demand for cotton out in the world market. And we look at the next line, sorghum, and that's Chinese demand as well. We did have our problems exporting corn to China with the unapproved traits, and they rejected some of our shipments over a year ago, but they bought a lot of sorghum, so they turned to sorghum. And sorghum prices just haven't had the downside that corn has, and so we see, as Corrine was pointing out, sorghum acreage up 11%. Now these are relatively smaller total acreage numbers. Another thing I think was you look at these 9 major crops in terms of acreage, go all the way to the bottom, and we see almost a 2 million acre reduction in these major crops. And as we look at that even more broadly and bring more crops in and bring in the conservation reserve, we dropped about 3 million acres out of that total crop base this year, or at least these numbers indicate that. Now, this was a direction USDA was tilting in the February outlook update that they had in Washington. And that was to say that prices are low enough on some of these commodities that there is some land in the United States that's actually not going to be planted this year. And so I think that's what we're seeing. When we broaden this out, there's about 3 million acres, 2 million are shown here. And where is that? It's mostly the northern plains, the Dakotas, Montana. Some of that is in the central plains. That's Colorado, western Kansas, western Nebraska. And then the southeastern United States would have been the third. But the biggest part of it on the plains, some marginal land that just simply may not get farmed this year. So we have a little supply response to low prices, but still that's only about 1% of U.S. acreage.
Well, and it's important to say that these are potentially acres that weren't in production 10 years ago, that with that price boom, with the ethanol boom, with the demand from China for soybeans,
very good point.
We really increased that crop base that's being cropped in the U.S. and maybe as prices have come down, we're taking some of those acres out and it's always that marginal land that goes in and goes out where it's not as high yielding and therefore at these prices not as profitable to
operate.
And
it tends to be a little slower to come out than it is to come into production. So we pulled some acres in relatively rapidly in that 05 to 2010 time frame. We're going to lose some acres. We started losing some here. We're going to lose some more perhaps in the future. But it's going to be a little slower to pull those out than it was to pull them in. That's based on our history.
I think that's right. And again, if we go back and bring some of that history in, when we really had surplus acreage, historically, the U.S. government was very heavily involved. Now, the direction of the U.S. government now, the area that we would have some land out of production is the CRP, the Conservation Reserve Program, and the government policy is still on the stance of reducing that continuing each year. So I think we're going to take 1 to 2 million acres out of CRP. That is a base that could come back into production. So right now, no government involvement, but historically, that's been the case in the United States to try to adjust an imbalance of supply and demand.
Let's turn our attention and start thinking a little bit about what's going to take place in 2015. We've got our first glimpse of that with the report yesterday in terms of what farmers intend as of March 1.
Right.
Let's talk a little bit about not only what the report says, but maybe what some of the implications are going forward with respect to maybe some additional changes that might take place. And Corinne, let's talk about cost of production for a minute.
So this is a cost of production slide. Michael Langemeyer at Purdue Agricultural Economics puts this together. And I was talking to him yesterday and I said, so how many updates have you done this year? Because he just released a new March update. And this year he's put out 4 updates of this Purdue crop budget. And he said that actually the biggest driver and biggest reason it's changing, it's not so much the costs are changing, but the prices are changing so much. So I think that's a record number of crop reports crop budgets put out by Purdue. So if we turn and look at this chart, there's a lot of numbers on here. So focus on really where those levels are in terms of that estimated variable cost per acre. This is the cost to put out all of your variable inputs, so your seed, your fertilizer, your chemicals, your insurance, your diesel, all of those variable costs, what it costs to put out an acre of corn in rotation with beans, beans in rotation with corn, and an acre of wheat. So for 2015, our crop budget is saying it's going to cost $446 an acre to put out an acre of corn, $222 an acre to put out an acre of beans, and $183 to put out an acre of wheat. What you see is those costs are pretty close to the highs that we established in about 2013. They've come down a little bit, but they haven't come down very much. So they remain high. The other big thing is it costs a lot more to plant corn than it does soybeans, about double to plant corn than soybeans. And so in a period that we're going into where cash flows are really, really tight, one of the reasons we've been talking about farmers maybe shifting more acres to soybeans is just from a cash flow cost perspective in terms of the cost of buying those inputs.
So the first thing I think is something we've been talking about all winter, and that is, can we pull down these production costs at all? And one of the things we've talked about in some previous webinars is the need to use the best science in your production plans and think about some of the strategies you might use with respect to seeding rates, use of fungicides, herbicide programs, et cetera, and make sure you're using the best science to try and pull down your production costs. But it's going to be slow, and the adjustments in those costs are going to be relatively small over the next year or two, but we do anticipate seeing some further declines take place. Chris, let's follow up on the fact that soybeans are so much cheaper to plant and what the implications might be here in 15 with respect to acreage. You've been thinking about that in terms of what might happen here the next few weeks?
Well, that's right. And again, I think producers really tend to look at the bottom line, that is returns, and we'll talk a little bit more about that. Corrine mentioned the cash flow aspect, and I think for those producers where their lender is really telling them we're watching you much more closely on your cash flow situation this year in 15, I think this does provide an incentive, but there are some pretty big financial incentives also for higher returns on soybeans. So I think that is probably going to bring more bean acres, and this report actually, we always keep in mind, it's prospective. That was as of early March. We already have more information than that, and obviously what people actually do, they can adjust from that March 1 intentions. So I think that's where we want to start thinking. What is that adjustment going to be and why? And here's one reason: cash flow.
Cash flow is one. The other one, and you just mentioned this, is the prospective profitability of these crops. That's what this one takes a look at. So this is, again, coming off those crop budgets Corrine was mentioning that Dr. Langemeyer prepares. And we've gone through and adjusted the revenues based on closing futures prices for yesterday and looked at expected harvest cash prices and used that to project some revenues and in turn project returns per acre above variable cost based on yesterday's close. And so if you look at a continuous corn, a return above variable cost, but variable cost only, of $112 on a rotation corn program, $173 on a rotation soybean program, which is the point Chris was just making, much more positive at positive 241. So at first glance, those look pretty good, Chris, but what does that not account for? It does not account for cash rent, does not account for machinery cost, does not account for family living. So if we think, Corrine, about what, average cash rental rates in Indiana?
Average cash rent for average quality land is roughly $220 an acre. And then when we think about that machinery and family living expenses, we generally assign about $150 an acre to that. So you would have to subtract $370 an acre from each of these, and that looks pretty tough.
It looks very tough, and so these are the most negative returns we've seen in many, many years, right? Projected here for 2015.
And you know, I think even if we look out into the future, the 16, 17, 18 crop, which we're beginning to get some pictures of, this may be the most severe tightness in terms of margins as well as cash flows. And so I think this does begin to talk to us about strategies, and that is one of the strategies that we know in life is we have to get through the short run to get to the longer run. And so for some people, they need to really be focusing on making it through this year. Just looking at closer to a 50-50 rotation, when you look at half corn, $173, half beans, you're only slightly over $200 above the input cost. And as Corrine mentioned, we're looking at cash rents, maybe something in that $220 range. These returns would not even cover average cash rent for average quality land, let alone, and that leaves nothing for family living expenses and machinery. Now there is one missing element here that we wanted to talk about, and Jim, you may want to talk a bit about the government program and how that could be some help.
We've got a few more days to sign up, in fact, so if you look at potential payments for 2015 using some kind of some ballpark estimates here, it looks like if you're participating in the Ark County program in Indiana, we might be looking at projected payments with average yields. That's, you have to make that assumption, but with average yields, our projections would suggest people might be pulling in government payments in the fall of 16, but attributable to the 2015 crop. $50 to $75 an acre on corn, a little bit less than that on the soybean side, obviously, but those will be substantial and those will be pretty important. They aren't going to turn a really negative situation into a positive situation, but they are going to help.
Yeah, but let's go back and talk cash flow for calendar year 15. So we're talking about this cash flow on the crop marketing. What about the 14 payments that they'll get this fall in 15? How much will that add?
In Indiana, not a lot. So, and I think we were talking earlier, Chris, roughly a third of the counties in Indiana on corn probably won't receive a payment off the ARC County program, which is probably going to be the program that most people sign up for. There's going to be some counties, a small number of counties, where the payments will be significant, but and then the remaining counties, that'd be just a modest payment. So we're not going to get a lot of help in the fall of 15 based on payments coming or attributable to the 14 crop. But the likelihood of significant payments coming out of the 15 crop in the fall of 16
and that really
pretty
contributes to this year maybe as the most severe cash flow payment as we proceed. If we can't get crop prices higher, then I think most of us believe we will see slowly some of these other input costs, and maybe some of that's cash rent as well. Those are going to come down some if we can't get higher prices over time, over the next several years.
And I think one of the other things to point out is when we think about management strategies that are successful in these low cost or low price time periods, high cost time periods, go back to when I started at Purdue, which was early 2000s. At that point, we would do a survey every year of the top farmer crop workshop producers and ask them, what are your secrets to management success? Every year, the #1 management strategy was to be a low-cost producer. We've just gone through this 8-10 year boom period where we had revenues going up higher than costs. We've now shifted into a period where revenues are, or prices are well below costs, and the management strategies that have made you successful in that period when prices were running up are not the management strategies that are going to make you successful in this period where prices have come down. So it's shifting back to those management strategies from the early 2000s and the 1990s, you know, and thinking about how do we become a low-cost producer again and really ratchet down and, you know, hold the microscope up to every single cost that we have.
That's right, and we are going to see pressure on cash rents, but it's going to take a while. We were talking earlier about the fact that cash rents do adjust. A lot of people will say that cash rents only adjust one direction, and that's up. History would suggest that's not the case. We have seen periods when cash rental rates come down, but they come down slowly. And we're seeing evidence of that here in 15 because I think rates in Indiana and much of the Corn Belt this winter and spring, very, very sticky compared to last year's rates, very modest reductions, if any, taking place. But looking longer term, 16, 17, 18, we are going to see those cash rental rates adjust over time.
And I think we have to say that is if this scenario that Corrine laid out of prices staying below cost. And again, we'll have to see how that evolves. That's, I think 15 is still a very transitional year.
It is a transitional year.
We're moving back to surplus, but we're not quite there yet. Depends on how yields work out this year, I think.
Well, but we should go to our scenarios, Chris.
Okay, well,
we'll
thought about this before.
We'll get to the scenarios in a minute, but you know, let's take a look at how things changed during the month of March. And I think, Chris, this feeds into your comment about acreage. During the month of March, what happened to those returns per acre on the corn side? Lost about $20 an acre during the month of March compared to where we were on March 2, the beginning of the month. Soybeans declined as well, but not as much as corn. And so when you think about it, what that really means is the bean-corn ratio or relationship continues to favor beans over corn even more strongly at the end of the month than it did at the beginning of the month. And I think that feeds into this idea that we could pick up some additional bean acres.
And the reason we always like to look at what were those economic incentives at the beginning of March versus the end of March is the survey that gets released on March 31st. The farmers were actually asked those questions the first week of March.
Right.
And so the farmers were asked the questions in the first week of March when the returns for both corn and soybeans were higher than where they are today. But you know, at that point, soybeans was paying $61 an acre more than corn, and today we're at the point where it's $7 stronger, 68. So we're in that trend where the market is interested in buying more bean acres.
And our guess is that we probably did pick up some bean acres during the month of March that didn't show up on the survey, and maybe pick up a few more here the next few weeks during planting season.
Yeah, that's right. And again, just from 11:59 yesterday, before the report and by the close, we saw enough reaction to add $23 more to the soybean incentive, which was already strongly positive. So I think this is exactly what the prospective plantings is to do. It is to get a reading at an early time, that is around the 1st of March, and then give U.S. producers a chance to adjust. I think we will go maybe 1.5 million more acres over to the soybeans and drop corn and probably a few other things a little bit. And that'll have some implications on price when we finally get to the fall harvest.
Let's take a look at the crop insurance side. We always like to take a look at the crop insurance guarantees and think about them relative to costs. So Corrine, let's take a look at those.
Well, we always like producers to think about risk management from the beginning, and certainly in these challenging time periods, it's really important to think about how you manage your risks so that you're still operating and thinking, manage the risk in the short term so that you're positioned for long-term success. And here the 2015 crop insurance guarantee for corn is at $4.15 a bushel, and for soybeans it's $9.73. That leads to protected revenue where we assume yields for average quality land in Indiana and then coverage levels of 85%. You'd have that protected revenue level at $582 on corn and $414 on soybeans. One of the big difference this year in crop insurance and that coverage level is it's covering what we consider to be about roughly 70% of total economic costs. This is a big transition from previous years where we've seen that protected revenue guarantee covering all costs in past years, but crop insurance is back to being its insurance function rather than being a profit-making function, which it seemed to, at the point where it's covering all of your costs and even guaranteeing some profit, that's a different crop insurance world.
And I think your data kind of helps support the idea of why this winter we were encouraging people to think about, if they had the opportunity to do so, to raise their coverage level. A lot of people in Indiana prior to this might have been carrying 80% coverage, for example, which was a relatively common coverage level. Because the fact that these coverage levels are declining with the decline in prices, one way to protect your cost of production is to raise the coverage level, and so that was one of the strategies we suggested when we were talking about crop insurance.
And of course there's higher costs for those premiums to raise that as well. And I think you like to think about insurance as a financial safety net. It's going to cover the shortfall. Crop insurance doesn't exactly work that way because when you have low prices and your prices are below your cost, it's based upon the price, at least a revenue product with these prices that Corrine's talking about. So we can think about that $4.15 price at 85%, which Corrine's budgeting through here. That's $3.53 price if you have your average APH yields. $3.53. Our total cost of production, if you have everything in there, is closer to $5. The insurance guarantee is $3.53. Wow, is that a gap? So when we really need the protection, it doesn't work nearly as well as it was a few years ago when you had high prices and lower costs.
Yeah, we were protected at pretty high prices with crop insurance. Let's turn to the balance sheet and think about what we're looking at with respect to carryover and projected price levels, Chris. So let's walk through the balance sheet a little bit.
Well, we'll look at the USDA numbers for the 14-15 crop. And go to the bottom, ending stocks about 1.8 billion bushels. Now again, we assumed here that the stocks number that we had in the recent report indicating over 100 million more bushels of corn than we had expected probably means those ending stocks eventually will get adjusted higher. So we carried in over on the very right-hand column for the 15-16 year that we're starting to think about planting that crop, corn and soybeans anyway. Now, we increased about 75 million bushels on that carryout to 1850. Again, taking the USDA numbers yesterday that producers indicated on acreage, 89.2 million acres, and 165 bushel yield, 13.4 billion bushel production. And that is substantially lower than last year's huge record. So that seems to be moving us in the right direction, but we do have bigger carry-ins, and so that ends up giving us just slightly less corn on the total supply, about 15.3 billion bushels. Now this, we're budgeting here a normal situation or fairly normal weather with normal yields. We're already in the process of continuing to build our livestock numbers. And as we build those numbers, obviously we're going to be feeding them for the 15 crop from September through August of 2016. So we're really locking in quite a good usage base in terms of the feed side. Then ethanol, at this point, margins are about break even on ethanol. We think these prices we're talking about around $4 corn, and even if oil's pretty cheap, that we're going to be fairly steady in terms of that total ethanol use, 5.2 billion bushels. And the bottom line then, we drop our carryouts down to around 1.5 billion bushels, and that should encourage slightly higher prices. So we're looking at around $4 corn as a season average price. This would take us, maybe the lows at harvest, 350, 370 for lows, and then get us up 4.25, 430 going into the following summer of 2016. It's always fun to budget normal, but sometimes that's not what happens.
So, Chris, one of the things we've been talking about is the risk to the balance sheet, and one of the things Karina and I were talking about in particular was what might happen with respect to those exports.
Well, and even actually going to this balance sheet, you can see that in our 15-16 projection, we dropped exports 50 million bushels relative to what USDA's current forecast is for this year, because as of the last 10 days, the export numbers are showing that exports right now are on pace, they're a pace below reaching what the USDA exported. So we think that exports are likely to be down for next year relative to where they are this year because of those macro factors like the really strong US dollar, which is on that next slide. So this is a weekly US dollars index futures. It's that dollar index relative to a basket of currencies. That basket of currencies is actually weighted a little bit towards the euro, but it's rated relative to our trade partners. You can see that that goes all the way back to the 2011. But the really dramatic thing on this chart is if you take a look at the last year, going back to sort of mid-summer of 2014, take a look at that run-up in the strengthening of the US dollar. We did the calculation this morning, about 25% increase in the value of the dollar relative to a basket of currencies from our trade partners.
Or we can say that the other way, it's a 25% devaluation of the buying power of some of our good customers out there. So when their currencies are worth so much less, if our prices were the same in the U.S. a year ago and today, it's really 25% more for those currencies.
Yeah, so that's the negative impact on exports.
That's the negative side.
Because they're paying more money than they would have been otherwise just because of the change in the currency value. And of course this has broad implications across the U.S. economy, but the ag sector is very heavily export dependent. Not just the grains, we're really not doing the meats today, but this is important for the meats as well, right?
Yeah, and I think it says we have considerable headwinds because we're big surplus producers of most agricultural goods, and we need to move those into the world market. And the dollar and other macro factors, including a weaker economic growth than had generally been expected in the rest of the world outside of the United States here in 15. So this tends to be negative broadly to commodity prices, and certainly agriculture is within that commodity group.
So you think about the balance sheet, coming back to that. Chris, you mentioned that based on the stocks report in part, you think USDA perhaps is going to wind up raising the estimate of last year's crop. And now we're talking about the fact that the export forecast, even the number we have in the balance sheet, we're a little bit concerned that even that might be too strong. There could be some additional weakness in exports. Those two combined, all that does is raise the potential carryover at the end of the marketing year, right?
It does.
And push prices downward.
And that's a negative for prices as we move forward. So.
Now we're going to anticipate, before we get done today, to talk about, we'll probably pull back a little bit on that corn acreage. So that can be a bit of a positive to price by the time we get there. And again, some shifting over the next 30, 40, 45 days, we think will maybe bolster from these prices that we've indicated at this point.
Let's take a look at some scenarios. So we've got three scenarios. We start off with the trend yields, which is what we had on the previous slide. That's in blue. And then we've got a good yield scenario and a poor yield scenario. Chris, you want to walk us through some of the numbers a little bit here?
Yeah, and again, the first column that says trend yields, that's what we've just gone through, the 165 bushels, with getting something around $4 marketing year average price on corn with a 1.5 carryout. Good yields, we went up to 173 there. This may be 15% odds we would be 173 or higher. And there we push up to around the 2 billion bushel carryout. And our struggle is that I think that 2 billion mark really begins to push us towards a surplus situation, where we begin to be concerned that we'll have multiple years of very low prices. Now again, we went down to 335 for a U.S. average price. This would tell us certainly harvest time prices would be $3 or lower than $3. And that is startling, but we look back to a fall of 2014 and said, we had futures and new crop bids that were that level or lower than $3. The other side, of course, that we do have weather problems perhaps, or something that gives us poor yields. We dropped to 155. And what we kind of felt like as we were going through that, we have to ration, but not severely ration, not really large cutbacks in usage. And what that tells us is you don't get the explosion of prices if you don't have to ration really severely. So we get those carryouts down to 1.3 billion bushels, and say corn would have a potential to push on up in the 475 range that we have here. And again, that says there's upside potential, but I think one of the things that makes us a little nervous for producers is that $5 total cost of production, at least on our budgets, and even a poor yield scenario doesn't even get us quite back to what we say full cost of production is. So overall, I think these are about where we felt corn would come in. I think $4 corn is kind of the number we've been talking, or at least I've been talking, for the next several years. One way or another, we've got to get a way to get our costs closer to that $4 mark, or under, obviously.
Yeah, and the other thing, I think, Chris, looking at those different scenarios, looking at those ending stock levels, you get ending stocks up around 2 billion bushels. We're going to see some pretty low prices, right? We're going to see the opportunity to see cash prices, particularly in a number of locations around the Corn Belt, drop below $3 at harvest time, like we did last year. Conversely, you see in a poor yield scenario, we really need to get the carryover below 1 billion bushels to get more of that rationing taking place and really get some explosive things going on in corn prices. With carryovers above 1 billion bushels, it's going to be hard to do that.
Well, and where we are right now at that 1.85 billion bushel that we're saying we're going to carry into next year, we're not quite at that 2 billion mark where it's really a surplus and very burdensome, but we're getting close to it because we're not seeing, with our poor yield scenarios, those explosive price situations. So we're already moving into that period where the price pattern for corn is changing, reflecting that we have very, very comfortable inventories and plenty of corn out there in terms of that inventory, so that it's really going to buffer those price responses, whether it's a good yield year or a poor yield year.
Yeah, and a much different scenario than we had just a couple of years ago.
Very different.
And it does, this year, I think 15, I mentioned that transition year. If we have that really good yield this year, we transition over to more of a surplus situation. And then markets begin to think multiple years of downside price stress. So this, I think, is a really, all years are important, but I think this one is particularly important in terms of not just this year, but the next 3 to 5 years as well.
Let's take a look at some futures charts. This is the nearby, the May chart, and we drew some price bands in there and suggest really that what we're probably going to be doing over the near term here is trading sideways in that trading range that we've established really over the course of the winter. So on the upside, that maybe puts a little bit of a cap or a lid on May futures at around $4. On the low side, maybe dipping a little bit below that 370 mark, but not a lot. So that's about a 30-cent trading range, maybe a 35-cent trading range over really the life of the contract going forward is where we kind of think we're going to be, barring some really unusual news between now and the expiration of the contract.
That's right. And again, yesterday, I think another factor that made corn so bearish after the report was that most farmers and a lot of the trade was leaning the other way. They thought it was going to be a friendly report. Look how we were trading right up to that $4 futures. A lot of producers saying, I want $4 cash. If we can get back up to $4.10, $4.15, we're going to get that $4 cash. So a lot of disappointment when that report came out. And I think in the short run, then you say that bottom has to hold in this market, or the line that's drawn on the bottom side of the channel. And I think that probably will hold. But a lot of disappointment, a lot of corn now that producers say it's almost getting to planting. What I want to get sold before harvest, I'm going to have, before planting, I have to get that moved out right now. So I think this could imply some basis, a lot of cash movement, basis weakening, etc. The other point of that is that those farmers holding a lot of corn right now, they can see the top of what this market is until we drive out of that band. And probably the best guess what will drive us out of that band is going to be weather.
If we look at D's futures, really the chart looks a lot like the May futures chart, just some different price levels, so that upper band maybe around 420 is our trading range we established over the winter. On the low end, about 392, 393. So we're in that same kind of a 30 cent, 25, 30 cent trading range. And likely to remain in that, and really the same movers for the D's corn. And I think really, if you think about it, we're starting to move into a kind of a weather market, coupled with possible acreage shifts, right? I think as we move through the course of the planting season.
And strategically, for the corn, we want to get priced, say new crop corn that we're looking at here, that we want to get priced this spring. We're looking at hope, fingers crossed, we get a retest up around that 420. That gives us near $4 out of the field. Our $4 price we'd mentioned on corn for 15, that's a marketing year average price. So certainly $4 out of the field, or the equivalent if you're selling January or March, would be above what our anticipation is for the marketing year. And what that says is that's a good place to be putting on some positions. We generally recommend 25 to 35% priced in the spring pricing window from about mid-March into, say, around the end of May.
And this is a year when you really ought to be looking at that, right? I mean,
there's a lot of vulnerability to the downside. There's opportunity to the upside. We have that every year in our crops.
So we always like to think about it as dollar cost averaging. Don't put all your eggs in one basket. Spread out when you make the sales, and really, hedge your bets.
Let's take a look at the soybean balance sheet, Chris. So we walked through the numbers pretty tightly on the corn. Let's walk through the soybean numbers a little bit.
Again, we'll look at the 14-15 marking year. Those are USDA numbers, 385 million bushels of carryout. And USDA's still looking at about 10.20 a bushel. Didn't have much difference on the stocks, so no reason to think USDA will be adjusting that carryover number, or at least very little, in upcoming reports. So we'll carry that into our estimates for 15-16, again with the modest increase in acreage to 84.6. We use 45 bushels of yield here as an average yield. And again, we'll just go to the bottom line, and essentially what that suggests is not a lot of change, moving up a little bit, a little closer to 400 million bushels of carryout, and not too much different than the 14-15 marketing year, but a little bit higher. Again, we've got prices at $9.50. When I was thinking acreage would be up 4%, I thought would be down around $9. So we did raise these numbers as the producers indicate they would not go to that many acres of soybeans. So $9.50 beans. Again, my longer term guess is that's going to be lower, that we will get more acres of beans, and with normal yields will be more in the 9.25 prices.
Yeah, so you're thinking that we might pick up 1 million, maybe 1.5 million acres.
That would be my guess, yeah.
And that would show up in the June report, which comes out at the end of June. So we'll get a better idea then. But that would add between 45 and maybe 70 million bushels of soybeans at these average yields, right?
That is correct. And then that pushes us more in. We'd been guessing 430 million bushel carry out, and that weakens those prices on down to around $9, we think.
So let's look at some scenarios on the soybean side. Again, that first column in blue is basically a repeat
Numbers
from the
we just
previous
went
slide.
through. Good yields, we went up to 48 bushels. And again, carryouts we thought could go over 500 million. And now this really does push us towards surplus numbers. And that there's some depression in looking at a price like $7.50 a bushel. Now, I think, would we stay at those levels? Obviously, the South Americans, I don't think they can raise beans for $7.50 a bushel. We would see some adjustment coming pretty quickly in the world on bean acreage. Poor yields, we had quite a bit of dynamics in terms of the upside. We used 41 bushels, and that brings our carryouts back to 158 million bushels. And we thought we had a shot at getting beans average price back up over $12 a bushel. So we've got quite a lot of dynamics here, lower prices, but a lot of strength to the upside as well.
One of the important things to add in that poor yield scenario is we kept the crush the same as what it is this year because we really do believe in the strengthening of the U.S. livestock industry and that they would maintain purchasing which would support domestic crush. The place we rationed was on the export side. If bean prices go up, then export markets would look to South America a bit more, so we ration on the export side. But overall, in that poor yield scenario, because we've got large ending stocks coming into this year, we didn't have to do that much rationing. But you get ending stocks down to that 158 level in that poor yield scenario, and it would set up a much more price responsive year the following year. You go to that good yield scenario where we start building inventories to that 500 million bushel range or higher, and it's the same story as corn. We'd be in that period of really surplus where pricing would have multi-year impacts, where multi-year looking at prices on soybeans being quite low.
And I think the other thing to think about is, and like we did in the corn, we've kept the acreage at the USDA number off this March report. And one of the things that's in play is a potential change in this acreage, right? So if you think about the good yield scenario, add some acres, that carryover becomes quite burdensome at that point.
Right.
So that's something to at least think about, right, in terms of some pricing strategies.
Yeah.
Let's take a look at the futures chart. Creed, you want to take a look at this one?
Well,
this is the nearby, the May chart.
The May chart, again, we see the long-term trend since the fall has been that the realization that, yes, the U.S. has a lot of soybeans and South America has a lot of soybeans, so there's a bit of a long-term downtrend. We have not yet retested the lows that were set last October. We're above those price levels, but there is a lot of downward pressure just because of the global supply of soybeans. At the same time, we're in a trading range that's pretty sideways.
With a lot of support on the bottom, obviously, too, and that gets us down around $9 beans. And what would make us go below $9 beans? Well, I think that's weather. That outstanding year where we have very good yields, with already a large record amounts of world carryout. That's pretty depressive.
The November chart, which we just put up on the screen, looks a lot like that May chart. And as you think about the weather scenario, Chris, and think about the acreage, the low we put in last fall again was around 930 or so. We're not too far away from that right now. We're at roughly 960, 961. So, if we'd actually have some weather and actually start looking like it's a good crop, and it looks like we've added some acreage, we could come back and test those lows pretty easily, right?
Yeah.
Well, I think that's right, in that the overall upper line, the overall market tendency still is to the downside. And we haven't resolved that yet. We haven't broken through that. We haven't said we've bottomed out and now we're going to build a recovery. So again, when you have an overall trend to the downside, that tends to say when you get rallies, when you get those opportunities, be looking at taking advantage of those.
So this is one where thinking about the new crop soybeans and thinking about doing some pre-harvest pricing, that might be particularly important on the soybean side.
I think that's right. Again, that 960 futures, my guess is once we get this acreage actually shifted over to soybeans, you're going to be closer to the $9 mark. And so pricing anything I'd say above 950 makes sense to get started on that 25 to 35% in the spring pricing window on soybeans.
And just to further support that idea, you know, going back to what we looked at with respect to crop economics, even at these current price levels, it favors planting more soybeans. And that's, from a long-term standpoint, going to continue to put downward pressure on soybean prices as we attract more acres into the soybean side of the equation. Let's take a look at the weather. This is the 3-month outlook on both temperature and precipitation. Corinne, you want to take a look at those?
So one of the reasons we like to put in some weather charts is we do keep saying that these markets are about to move into being weather markets, where the futures markets are going to be looking to the weather to influence prices. And so when we look at that long-term forecast, that 3-month window, which is the April, May, June, that's our planting period. For the most of the Corn Belt, and certainly for Indiana, we're in that world of equal chance. So that's pretty much saying that they don't have any reason to predict anything other than normal temperatures and precip. The chart on your left is the temperature one, and the chart on the right is the precipitation one. Now, for places like California, in terms of temperatures, they're going to continue to be hot, and you can see actually quite a warming band all around the rest of the U.S., but not in the center of the Corn Belt. Then we look at precip, and it's just wet in the Arizona and New Mexico area.
Let's take a look at the drought monitor, Chris. You know, and Corinne just had the temperature chart up there. If you think of the places that were, at least on the western part of the U.S. that are going to be above average in temperature, those are the same places that are experiencing severe drought.
Well, that's right. And again, we've got a divide in the country with the West remaining very dry. We saw that through the winter and longer term. But we also see this kind of the central and towards the southern plains. There is concern in the wheat market now, of course, on hard red winter wheat that Kansas, Oklahoma area could be really beginning to show signs of lower ratings on the wheat crop and concern about the hard red winter wheat, which is our biggest wheat category. I think the other thing that we're very well aware of is the dryness in the upper Midwest and the Dakotas, substantial portions of Nebraska, all of Minnesota, a little bit of Iowa, Wisconsin. So setting up here for an area that is very important to us in terms of corn and soybean production. And so as you look at corn prices down sharply, I think the market has to start talking about weather, look at some of these forecasts, and say better not push those prices too low too quickly because we can trim substantial production very quickly with weather.
So let's take a look at the forecast for the seasonal, the drought outlook, and kind of reinforces what you just said, Chris, with respect to the upper Midwest.
Well, I knew this one was coming up.
That
is the Minnesota, Iowa, Dakotas, and Wisconsin, I guess, area. The darkest coloring there, the brown, is that the drought will persist. Now, this is a projection from NOAA, National Weather Service, through the end of June. So this would be spring and into the early summer, but it's pretty ominous. The more orangey color is likely to develop droughty conditions. Now, we didn't bring a visual, but did look at subsoil moisture, and that's showing western Iowa and the southern portions of Iowa, 3-4 county tier of counties in southern Iowa and western Iowa, all with a pretty deficit, 50% or less subsoil moisture, and that's from the surface of the soil down 72 inches. So I think there are concerns at this point. We know that March, April doesn't determine the size of the crop and yields, but there's some ominous pictures out there, and I think the market's well aware of these.
Yeah, it just kind of points out that there is some risk here because we had some very strong yields in that part of the country last year.
Absolutely.
And we could see a different scenario develop here in 2015.
And I remember particularly Minnesota did very well on yields in 2012, at least relative to the eastern Corn Belt, where that 2012 drought, the most intense part of it was in the eastern Corn Belt.
Yeah.
Maybe this is their turn.
There you go. All right, let's talk about summarize some things and maybe some strategies. So we've kind of pointed out that Corn stocks were high, in fact higher than expected on the grain stocks report. That's given us some weaker old crop corn prices. We also didn't get as many acres coming out of corn on the prospective plantings report. That also contributed to some of that weakness. Soybean stocks were about where we thought they'd be and where the trade expected them to be, so no big change there.
Yeah, we expect, as we said, with the higher stocks number, over time USDA will be adjusting upward the corn carryout. Now some of that could come as early as April 9th if they think they can reduce exports as we talked, but over time that would be the direction we would expect. We'd mentioned the basis weakness. There's a lot of old crop corn still to come out. This does make us nervous about how much still has to be brought into the marketplace. And I think we've talked about going through that winter price range. We don't break out of that. That's what we want to look at for now and really see where does weather, planting, and final acreage take us.
And you know, the next point, I guess, is the fact that we had smaller than expected soybean acreage on the prospective plantings report. That's a little bit encouraging for soybean prices. We saw some of that show up yesterday. And I think our bias would be, if we do see some strength in soybean prices, take advantage of it.
Certainly. I mean, we're going to go to the new crop summary, but you know, we think more acres will come into soybeans, and once the market establishes those acres and realizes that those extra soybean acres are out there, that would be put further downward pressure on soybean prices.
Yeah. So
and the old crop and new crop are influenced by some of the same factors. So new crop pricing and probably finishing up or doing more old crop.
Well, if there's more beans coming next year, then what you have in inventory this year isn't as valuable.
Yeah.
And so, yeah, the 2 years are certainly linked.
And again, as we've said, probably the biggest factor is going to be weather now over the next several months. And will we stay within that trading pattern we mentioned, or are we going to break out of that? Probably the best guess, weather will be the factor that would cause us to break out of that
Either
range.
on the upside or the
downside.
Yeah, and we move into April, and that's a traditional thing in the futures market. We turn our attention away from the plantings report and the grain stocks and start thinking about weather conditions and what's taking place with respect to planting progress. So let's talk about the new crop side for a little bit. So we've been talking for several minutes here about the fact that we're going to see, we expect anyway, to see some additional acreage shift over to soybeans. Maybe as much as 1.5 million acres. I mean, at this point, it's anybody's guess, and that could be weather influence, but certainly the economics would favor that, right?
That's right. And again, this is where we've laid out several strategies. Maybe bean prices are somewhat higher now than they will be as we see that acreage actually shifting. I think, you know, one of the points we have kind of come to is, hey, think about $4 corn. Think about $9.50 beans. That may become $9 beans when we get more acres. And what is your cost? Can you raise corn and beans for those kind of price levels? We should strive to get those costs at those levels or lower over time.
So I mean, to add to that, I mean, there's sort of, we're talking about marketing strategies, but we're also talking more broadly about farm management strategies. And there's a limit to what marketing can do when the market is offering you prices below your cost of production. And so that's really saying that the farm management strategy is really to focus on those costs, because marketing isn't going to get you out of this low cost or this low price period.
And the other thing I think about, Corinne, is maybe a point that you and I made when we did our webinar last fall. And that is, we're in a different environment now. We were at a period from 2005 or 6 up through 2012, 13, where strategies on the marketing side, where you kind of waited for the future, tight supplies, holding on for an expectation of stronger prices, made all the sense in the world, right? But if you think about the environment today, where we're transitioning into this higher carryover, more burdensome supply situation, being more aggressive, pricing perhaps a little larger percentage than you have in recent years here early in the season, before harvest, et cetera. Taking advantage of opportunities as they arise, not always waiting for the future. That's a different mindset than what we had in recent years, and I think it's one we're really advocating here today, particularly with respect to both, well, really soybeans and corn. If we see any strength at all here show up in soybeans, we really think selling some old crop and new crop makes a lot of sense. We think protecting prices on Corn makes sense as well. So that's a little different mindset, and I think it ties into your comment about marketing isn't going to bail you out in the sense that we're not going to see prices get all the way back to cost of production. So don't hold on for that. Take advantage of some opportunities as they arise and spread your marketing risk out.
Well, and we say this with full recognition of how difficult 2015 is going to be. And, you know, it's a different mindset. It's thinking, how do we minimize our losses, reduce our risk? We've got to make those short-term decisions to position the farm for the long term.
And I think there's maybe a bit more of a survival strategy too that we, or attitude that we take on. We know there's upside opportunity. I think on our summary points we talked about if weather is adverse, if we lower those yields, maybe we can push those prices back towards the high fours on corn, and maybe we can push the beans back to $12. But again, if we're the ones that have the lower yields, our cost of production per bushel go above even those kind of numbers. So I think we will re-mention again this transition kind of a year. We're really worried that if we have another reasonable crop or an abundant crop, that we're really now building us towards surpluses, which give us a longer term negative tone going forward. And then again, I think we have to point out in this survival, crop insurance just doesn't do the same job of protecting at or above your cost as it did back in 2010, 11, and 12. In the government program, that is going to be very important, but unfortunately for 15, the government program payments will come from the 14 crop, which are relatively small.
In most cases, that's exactly right. So we'll get some help there, but maybe not as much help as we thought perhaps when we started talking about the Farm Bill last fall, because when we did that, we didn't anticipate yields in many of these counties being quite as strong as they turned out to be.
So I think one of our themes is find a way to survive and get through 2015. In the long run, there will be more adjustment. Either cost will come down or prices will come up in the long run, and the margins won't be as tight, but now is the really crunch period.
I would agree with that, and I think following up on that, if part of your strategy winds up being maybe shifting some more acres to soybeans, I think we would encourage you to be fairly aggressive about locking in some of those returns to take advantage of what appears to be right now a situation that would actually favor planting more soybean acres versus corn. So.
Right.
All right, with that, I think we'll wrap it up for today. I really appreciate Chris and Karine joining me today on the webinar, and hope you've enjoyed it as well. A recorded version of the webinar will be available on our YouTube channel, and if you registered for this webinar, and if you're watching, I think you probably did register. If you're registered, you'll get an email from us letting you know when the recorded version is available, and we'll be doing some more webinars during the rest of 2015, so look for future emails from us here at the Purdue Center for Commercial Agriculture.
And we'll be making a PDF of the slides as well, right? And making those available too. So. Yeah.
So with that, on behalf of Purdue Extension and the Purdue Center for Commercial Agriculture, thanks for joining us, and we wish you a pleasant day.